Our next speaker, many of you have seen him in the YouTube, in the TV channels, everywhere you will see him. That's why we kept his presentation in the second part, because you will get more time to interact with him. He is Pranjal Kamra. He is immediately he passed away from NISM. He has, while he was studying in NISM, his way that he was preparing. While he was studying at NISM, he was not any of the placements, and that came fruitful in very short period of time. In these 3 years, formally introduce him. Pranjal Kamra is an alumnus of NISM. He founded investing accessible for the masses, and is currently one of the most popular investor education and equity research platform in India. Astronomy, it is available in Flipkart and Amazon. That book is on the stock market guide that makes you rich. He has more than 2 crores rupees from his YouTube channel itself, and he's having a good screener. You can use his screener for all the fundamental analysis. Many TV channels. Recently, he's an inspiring advisor for the bottom level people in the society. You know, his company is located at Raipur in Chhattisgarh. It's in a remote location, and he's helping the bottom level of people, those who are getting they are getting the mis-selling of many of the financial products like microfinance and other things. So he's saving them from the mis-selling part and from the frauds, and he's giving a ethical advice on how they can manage their personal. See his LinkedIn, obsessed with value investing and possessed with by Buffettology. He is very soon he will actually regarded as Warren Buffett of India. We and he's a recruiter of NISM also. Regularly he recruits our students. Many of our alumni are working with him, and he's also taking some of the students on internship basis. I will not take much time of him. I'll request Pranjal to start his presentation. Please, Pranjal.
Right, sir. Am I audible, sir? Visible
Yeah.
and audible?
Yeah.
Hello, Panda sir. Hello, Ritesh sir. It's an honor to be here. I mean, just a second. I mean, I saw a notification regarding allowing your software to record the screen. So just a second, let me activate that permission. Yeah. So thank you so much, sir, for inviting me here. It's always an honor, and I mean, thank you so much for making this a part. This is a very emotional moment. Anytime I'm involved in anything that has to do with NISM, it's a very emotional moment. Congratulations, everyone who have decided to join this institution. Trust me, these 2 years are going to be the best years of your life for sure. You're going to learn a lot, learn what is life, learn the real world. So definitely, you are in for the best 2 years. I was here for a year. Back then we did not have a 2-year course, and I really regret that NISM did not have a 2-year course back then. But yeah, you guys are more lucky. You'll learn double of what we learned. So I'll keep it very light, because firstly, I'm not too much into numbers. I've never liked numbers. Panda sir would agree. I was one of his worst students probably ever. But this is the greatness of this institute, that they don't even leave their hands, and they don't even stop supporting their worst students. And because of the support that I got at NISM, I am whatever I have achieved, a huge part goes to people like Panda sir and all the great teachers NISM has and had at my time. So, it's not very technical. I'll give you some basic pointers which will help you at NISM and which will help you beyond NISM. So it will not be very technical. There were certain things that I experienced at NISM. Firstly, as the previous speakers spoke, that some of the people who come to NISM consider it as a placement agency, as a recruitment agency, that you come here, pay the fee, and after your 1 year or 2 year, you deserve a good job. So, you have to realize that NISM, it's an educational institute. It's not a placement institute. Placement is an add-on that NISM tries their best to provide, but you shouldn't judge this institute on the basis of the package you get, because it's much more than that. The 2 years that you spend here, it has the best library in India in the subject we are being taught. And it's more about making use of these resources. I'm sure when you go to the campus, you meet your colleagues, you'll find out that some of the brightest and the most passionate young minds who are interested in the field of finance are your colleagues, are your students with you. So it's about networking. It's about making friends with some of the brightest minds who have become your batchmates. It's about making use of the library, about making use of teachers, connect personally with teachers, go discuss things with them. It's more about that, because if you do all that, in the long run, you're bound to be very, very successful, regardless of what package you get just out of campus. That's just the short term. So I'll talk about investing, value investing, fundamental analysis, how to pick stocks and things like that. But these core things are more important. One thing that's critical in your success as a student at NISM is going beyond the curriculum. Now, why is this important? Imagine this. I don't know how many students have joined, 80, 90, 100. So if you stick to the curriculum, there are 100 other people studying the exact same thing, the same books, they're preparing for the same exams, they're covering the same syllabus. So no matter how good you are with curriculum, you're still almost the same as other 100 people. There's just nothing different about you. You don't have any USP. So what will make you different is what you read and what you do beyond the curriculum, apart from the curriculum. And this is where it becomes really important that you make use of the library. That is what will differentiate you from 99 others. And when the interview happens, that is what will matter, that what you know that's different from all the previous people who the recruiter has interviewed. So going beyond the curriculum is critical. And also one important thing about how you should spend your life with NISM is that securities market, finance is a very, very broad field, very broad field. So so you have a 2-year course. In the initial 4-6 months, you have to analyze that what is your domain, what interests you. Is it commodities? Is it currency? Is it trading? Is it F&O? Is it intraday? Is it technical? Is it fundamental analysis? In my case, it was value investing. So because if you identify what interests you and you identify that what kind of jobs you're looking for, so this attitude that I'll sit in all interviews and probably I'll crack the one that pays the highest will not take you anywhere, because there are other people who are focused that, okay, I only want to go in the treasury desk of a bank. So for the 2 years, that guy will be preparing for that interview in that sense. And if you don't have a goal that what kind of job I want, you will not be prepared. The other people at interviews will leave you behind. So even in my case, I was pathetic in some subjects. Anything that had to do with debt, anything that had to do with F&O, currency, commodity, I had no clue. But when it came to fundamental analysis, I was very, very confident that although I was not looking for jobs, but I was very confident that if I sat for an interview, I will be selected or I'll be amongst the top 2, top 3, because I had worked for the entire year on my fundamental analysis thing. So identifying your niche, identifying your moat is very, very critical in you becoming successful. Don't try to do everything and prepare for all kinds of vacancies. It doesn't work that way, right? Yeah. So now, I mean, it's interesting that let's start with how the basics of investing, picking stocks, valuing stocks, equity valuation and things like that. For some of you who are here after doing graduation in commerce or are pursuing either CA or CFA would know that whenever valuation comes, the first thing that we think of is probably discounted cash flow, EV upon EBITDA, sum of parts, and things, various valuation methods that we have. So here's the interesting part. I have always believed that so one of the key things, whether you are picking stocks for yourself or for your clients or for your firm, anyone, one of the most critical things is valuing the stock, whether this particular stock is undervalued at rupees 100 or overvalued at rupees 100. And the way we are taught that this is scenario analysis, this is DCF, this is sum of parts, these are the valuation methods, and you apply and you figure out if it's undervalued or overvalued. This is, so personal opinion, this is greatly flawed, because valuation is more of an art. It's not a science. You cannot have a precise answer that okay, I'll project free cash flows growing by 15% for the next 5 years and I discount it and here's the fair value. It just doesn't work that way, because if investing or projecting cash flows or projecting future earnings of a company was this easy, trust me, humans wouldn't have been required. Machines or softwares would have done it the best. Analyze the past growth in free cash flows, analyze the past growth rate in earnings, and adjust it with certain amount of conservatism and project it in future and discount it. Machines can do it very, very well. The fact that humans are more successful than machines in investing proves that such thumb rules, such definite methods don't work in investing. So, this is very academic. This is the way it's taught in academics, but in the real world. So I hire a lot of investment advisors, research analysts, and if someone comes to me and in the interview I tell him that okay, this is the company, these are the profits, these are the cash flow, find me the fair value. And if he just does a DCF and gives me the paper, I'm not interested in that person, because he is very limited with his scope. So what's important about valuation, how you should value a company? This is very, very ironical in the sense, because how will you value a company? You can only value something right? So when we go to a mall to buy a shirt, we just touch the fabric, we maybe give it a try, and we instantly know whether that shirt is worth the price or not. Why does that happen? Because we have tried clothes all our life. So we have the experience of identifying quality and then comparing the quality with the price. It's built in because we have been habituated of it in the last, say, 20 years of your life. You're roughly 20, 22 years of age. But we try to value companies without understanding about them. So most of the people, even on this webinar, if you invest in stocks, you must have invested in, say, IT stocks, HCL, Infosys, TCS, and things like that. And yet, most of us don't know the difference between a TCS and an Infosys. What's inherently different between their business model? All we know is these are IT companies, and probably the next thing we would know is they derive a substantial amount from banking, insurance, and financial sector. That's all we know. But we don't understand what's inherently different in these business models. So until you don't know what actually Infosys does, you just cannot project anything, because you don't know from which industry that company is deriving profits. So if you don't know which industry is Infosys dependent on for its profits, you cannot make an estimate as to how those particular industries will grow. And if you don't know how much those particular industries will grow, on which Infosys is dependent, it's 100% impossible for you to predict by how much each year Infosys will grow. These are as simple things, but a lot of analysts also, they don't do it. They just go the academic way and not the practical way. So, even if you invest personally, it's always ask this one question from yourself. Do I know the company enough to be its CEO and run it profitably? So, I see a lot of people right now in the last 2-3 months going madly behind pharma stocks. And most of us have no clue what differentiates a Cipla from a Cadila. Most of us don't know. All we know is pharma company, these are pharma companies and pharma companies will be doing well, let's invest. You're not going to make money for you or for your clients in the long run, despite the fact that you must have done complex Excel modeling, Excel calculations and arrived at a fair value. The point is, every valuation metric that you use, its efficacy depends on the kind of projections you assume in your calculation. And those projections just cannot be right until you know enough about the company to be its CEO. So if you don't know what differentiates a Cadila from a Cipla, you shouldn't be investing in either of those. Because, if you know the company enough, you wouldn't even need an Excel sheet. So it's said that the most famous tool of writing fiction is not Word, it's actually Excel. It gives you whatever you want because everything is dependent on your assumptions. So it's good for our internal satisfaction that if I think that cash flows of Infosys will grow by 15%, I input 15%, do the DCF and find out that, okay, the stock looks still overvalued. Let's try 18%. You try 18% and now it looks undervalued, and you will internally justify that 18% is the right thing, is the right assumption. So numbers are very limiting. We think when we don't know much of finance, that at least the equity valuation part of finance, that it's about accounting, it's about numbers, it's about being a good accountant and a good mathematician. Honestly, 80% of equity analysis is qualitative analysis. If you know the company inside out, you don't even need an Excel sheet. Intuitively, you'll know whether the company is undervalued or overvalued. You don't need to do any calculations. We do all these calculations to justify our biases, or maybe to try and compensate for our lack of information or misinformation. But most of the analysis that you should do about any company has to be qualitative, understanding its moat, its competitive advantage, what differentiates it from its competitors. A very simple example, MRF. Now, tires globally, except specialized tires, most kind of tires are a commodity. But here is a company, MRF, in India, not just in the last 10 years, in the last 30, 40 years, it's consistently a market leader, and the market share is substantially higher than any other player. So, before investing in MRF, do we do enough analysis to actually try and understand why is it MRF number one? We all know it's number one, and thereby we invest, but we need to go to the core and figure out why it's number one, because only then we can project whether it's set to remain number one in the next 10 years or not, whether the strengths that it had because of which it became number one are still intact, or whether a new competitor is encroaching into its territory and eating market share. But I see a lot of people investing in tire companies and investing just because it's growing rapidly, it has good market share and things like that. So yeah, it's very disappointing that way. And so I'll give you an example. Now the next question, because the next question that comes to mind is, in your mind must be coming that if I follow what Pranjal is saying, if I need to understand on the core, in the core, what Cadila is, what Cipla is, it will take a lot of time, and that way most of the companies I'll have to ignore. So there will be only a handful of companies left in which I'll be able to invest if I follow what Pranjal is saying. I'm sure that question is coming in your mind. But here we need to understand one thing, that in your life, how many great multi-baggers do you need to change your life? So, Warren Buffett has this rule of 20 punch cards. So he says that imagine you can only buy 20 stocks in your life. And every time you buy a stock, you punch a card. After all the 20 cards are punched, you cannot buy any more stocks. If that was a limit, if say SEBI had a limit that you can only buy 20 stocks in your life, how much careful would you be before investing in a stock? How careful would you be? Just because there's no cap on the number of stocks you can buy, we buy stocks carelessly and we incur losses all the time. And you know, in a year, even if you analyze 10 companies, just one company a month, but in depth, and out of those, you find 2 or 3 companies worth investing, and they turn out to be wonderful stocks. You don't need to analyze a new company or read a new research report every day. It's just complicating things. Investing is very, very simple. So it's important to stay within your circle of competence. So before we go to circle of competence, it's slightly detailed. I'll tell you one more thing. So I have a thumb rule that go for companies that are in slow changing industries, in industries which don't change quickly, because change is hard to predict. If we try to imagine that in the next 5 years, which IT company will be the Indian leader in artificial intelligence or machine learning, very hard to predict that, because we hardly know anything, and these industries change so rapidly that it's very hard to predict this. But if I tell you that, can you reasonably predict that even in the next 5 years, Coca-Cola and its group beverages will still be number one in carbonated beverage category? It's reasonably easy to predict that Coca-Cola has been the market leader since last 100 years. So we can predict and project that, okay, in the next 5 years also, there is no suddenly a new player coming up that will launch the next sensational thumbs up and suddenly wipe away Coca-Cola. Their distribution reach is a huge competitive advantage. So even if someone launches a good product, it will mostly be impossible for that person to make sure that that beverage is available in every, say, pan shop in the rural areas too. It's almost impossible. Coke will eat that company alive. Also, if imagine yourself to be in the shoes of Apple, you are the new Apple CEO. Think of the kind of innovations you'll have to keep doing in order to stay relevant. An iPhone goes out of date in 2 years, and every year company has to think of something new and launch a new revolutionary product. How exhausting is that? How mind draining is that? And this is why we see that BlackBerry came and went away, Nokia came and went away, Sony Ericsson came and went away, because it's almost impossible to innovate every year and be the best innovator every year for 100 years. It doesn't work that way. You are bound to falter along the way. Now think that you are a CEO of Coca-Cola. Imagine how good a life you have. What is Coca-Cola? It's sugar, it's color, some secret formula, it's carbonated water, and that's it. Bottled in a plastic bottle, labeled in red and white. And it has been the same for the last 100 years. So a good Coca-Cola CEO would be someone who goes to the office and sleeps, literally. He does not have to think every year about launching a new innovative version of Coca-Cola. He does not. So whose job intuitively is much more easier? Apple CEO's job or Coca-Cola CEO's job? The value of Coca-Cola is in not changing. How good is that? Imagine running a business in which you are paid to not change and remain what you are. It's much, much easier. And thereby, these businesses are much, much stable. So when you are a beginner, you think that you cannot understand complex businesses. It's just too much for you. Stick to simple businesses. There are tons of simple businesses in India. Colgate is one, Gillette is one. Everyone understands those businesses. No rocket science. So as a beginner, stick to those businesses. You'll not lose money. And again, in investing, it's critical that you don't lose money, because the market historically has grown by 12-13%. So if you don't lose money, you will definitely grow up, at least according to the index, if you don't lose money. So cutting your losses, avoiding losses is key. And I see a lot of institutional investors as well, mutual fund managers as well. They don't, doing blunders. Now, they don't do blunders because they lack knowledge. They do blunders because they try to be a hero. Because suddenly assuming that, okay, this is a stock that everyone hates. This is something that no one likes. I'll bet on this. If it grows, I'll be the national celebrity. So that is where most people go wrong. So investing is not about trying to be brave. Investing is not about trying to be a hero. It's about being patient. It's about doing the boring thing. It's about doing nothing most of the time. So doing nothing is really tough for most of us. We want to feel like we are doing something. We want to be in the middle of action, not doing so. In fact, we get these queries at times that someone buys our advisory product, and for the next 6 months we don't have a new buy, we don't have a new sell. Our model portfolio remains as it is, and we get a call from them that it's been 6 months, half my subscription period is over, and you have not done a single new subscription, single new transaction. So then it takes a lot of explanation to make them understand that you are not paying us to make you buy and sell. That is what brokers do. You are paying us to grow your wealth, and let it do it our way. So it's important that it's important. It's also important because now you will be amongst 100 people, and all day, all night, you will have conversation around stocks. And guess which person looks the most smart? The most smart person in the group is assumed to be the one who knows the latest trends, who has certain secret strategies, some F&O formula that is guaranteed to make you returns, and someone who knows about the global markets, what's happening. Honestly, most of that is noise. You don't need all that. Because why do you want to bet on the news? Why do you want to bet on the every new thing that's happening every day? So even at Finology, we are an investment advisory firm. We are a company that has a research tool for the masses. So we are into equity research analysis like any other firm in India. And yet, trust us, we don't have a terminal. We don't have a television running CNBC and people shouting from their television screens. We don't even check the market every day. So at our office, it's a strict policy that from Monday to Friday, we don't care where the market is going. Even I don't open my Kite app during weekdays unless I want to make a transaction, buy something new or average out. All this, the review and where the markets are, what the news is, we check on Saturdays. Because if you are watching the TV and the anchor is shouting that market is crashing, the market is doomed, you need to get out of this, you need to get in this, all these noise, all those colors, all those movements happening on the TV screen, they take away your sanity. You are no more thinking independently, and you are being induced into taking a certain action. That is how our minds work. I'm not saying they want you to do certain things, but that is how our mind works. If someone in an expensive suit and someone who's being projected as an expert is shouting from the TV screen that if you don't act now, you're doomed, you will. And if you change the channel and there's another person again in an expensive suit shouting the same thing, you will doubt yourself and you'll start believing in that. So it's important to cut yourself away from the noise. Prateek just mentioned about a person in the equity market. He bought a certain stock, and then after a few decades, because he was not well, he went into a coma. When he came back from coma, he realized he had bought those stocks, and those were worth X amount, a few crores in few years. That happened because that person went into a coma, right? You and I, if we don't get into coma, we transact and we sell out. So it's important that you buy good companies, simple companies you understand, and then go into a mental coma. Don't check the market. Otherwise, if your stock goes from 100 to 200 and come back to 160, you will have that itch to, it's already down from 200 to 60, 160. I should have sold at 200. Let's now save my profits of 60. Otherwise, it will come back to 100. And all sorts of doubts arise. So it's important that you stay away from all these noises and remain sane from all of that. Again, coming back to circle of competence, please don't chase the next hot sector or the next hot company. It's, if you are into electronics, just just see which is the hottest selling automobile, which is the hottest selling two-wheeler, which are the companies who manufacture parts for them. If you are into clothing, beauty, things like that, just go to a shopping mall, stand outside, see from which shops are people coming back with their bags full and their faces giving a happy expression, and which are the stores which has lesser footfalls and people don't have their bags full. And you instantly know which clothing brand is good. We all see that DMart, the stores are much, much, much more filled. People love the discounts at DMart, and which was not the case with Big Bazaar. And we see what's happening with DMart and with Big Bazaar. So most of the times, it's as simple as that. And coming to so how do you identify good companies? You identify good companies on the basis of your eyes. Your eyes are your most important senses in trying to identify companies. So thereby, even we stick to B2C companies, businesses we can see, we can experience, we can try, and then make an opinion as a consumer, and then try to analyze it as an investor. And when coming to analyzing it as an investor, we don't buy a company if it's not a blind buy. If you need an Excel to justify the price at which the share is trading, it's not cheap enough. Just ignore it. I'll give you an example. There was this company called NMDC about a few years ago. It was trading at a market cap of, say, I don't remember the exact number, but say the market cap was around, for example, 1,000 crores. So basically, theoretically, I can get the entire company at 1,000 crores. And luckily, that company had a bank balance of 1,000 crores. So if I buy all the shares and become the owner, that 1,000 rupees lying in the bank is also mine. So basically, I'm paying zero for that company. It was as simple as that. The company was free of cost, a government company. So no problem of going out of business or a scam happening. Very, very healthy company in the sense that paid great dividends because earned very good profits each year. About, say, if about 30% of its market cap, it was earning every year. So if the market cap was 1,000, it was earning 300 rupees every year, had 1,000 rupees in the bank balance, no debt at all. Now, you don't need an analyst to buy such a stock. You don't need an Excel sheet to justify such a stock. You're getting the company for free, and plus every year, now you'll get 300 rupees of profit. It does not take an analyst to buy such stock. And when in your life, you only need a couple of dozen companies to be rich, why not go for blind buys? Why go for those compromises which look overvalued, but just out of FOMO? You want to invest in that so that if it grows, you don't miss out. Don't take such complicated decisions. In investing, you're bound to make mistakes, and thereby it's important to keep as less projections, as less variables as possible while making your decision. Because the more amount of projections you have to make, the more likely you are to go wrong. So it's important that you keep it extremely, extremely simple, right? I'll just see. I think we are running out of time, sir, or I can continue.
No, Pranjal, we can continue. That's perfectly fine.
Right. Okay. Thank you. Right. So let's talk a little bit about moats. I think that's really, really important. So what are moats? I'm sure some of you already know of it. So moats are competitive advantages. Basically, in a capitalist world, if one company is doing well, if one company is earning lots of profits, there will be a lot of copycats coming in, trying to do the same business and earning again so much money. So everyone was hesitant to launch a TV channel in the early 90s because it was a very, very expensive proposition and not many people had cable TV. So Z was the first one to launch a private 24-hour TV channel. And once that was successful, now what? We have, I guess, more than 5,000 TV channels because they saw that the first person was very successful. So let's get into it. And now we see Z Group being in problem because one key reason. It did not had anything that protected its business by other new entrants. So Star came in, Sony came in, Viacom 18 came in, and boom, Z is gone. Because there was no protective barrier around it. Anyone could start a new TV channel now. They got funding from ventures because Z had a proven business model. So now people were willing to fund a new TV channel. And suddenly a lot of people got access to money and started their own TV channel, and competition was much more, and it was not sustainable for them. So any company that you're analyzing, one of the first questions should be whether you understand the business or not. And second should be whether that company has a strong moat or not, a competitive advantage that protects its business. Say a patent could be one. If a company figures out how to beat this COVID through a vaccine, it can get a patent on that, and for the next 15-20 years, no other pharma company can make that vaccine without license from that company. So even if you want to compete, you cannot compete with that company. You have to do a licensing deal with them and pay them a part of whatever you earn. So that's one. Second could be network effect. I really like this example of WhatsApp. We all use WhatsApp not because it's the best or because it's the cheapest. Every chatting app is free, and we have not even tried others to know if WhatsApp is better or others are better. We simply use WhatsApp because everyone else is using it. So, usually, how do you defeat your competitor? How do you increase your market share? Either by offering a similar product at a cheaper price, or by offering a better quality product at a similar price, or offering a better quality product at a cheaper price. That's just killer. But how do you compete with WhatsApp? It's free, so you cannot be cheaper than free, and it's not the best. There could be other apps which are best. So it's not number one because it's cheap. It's not number one because it's best. It's simply number one because everyone is using it. So how do you defeat such a company? It has a strong network effect. So there are a lot of other such kinds of moats. So I don't think I should discuss all the moats because then you'll not go to library. The most valuable thing I did in my library was reading day in, day out about moats. So one has to be the most interesting and valuable concept in finance, and unfortunately in equity valuation, and unfortunately moats is the chapter which is often not taught in a lot of places. So I had just another while saying this, I just had another thing in mind. Panda sir, with your permission, I just thought of a thing that, since these people, these new joinees are currently studying from their home, so I guess they are not able to access all those subscriptions that you have, such as Bloomberg terminals and things like that. So is this possible that, since I have always believed that whatever I am is because of NISM. So I just thought we could do this, that till the time they're studying from home, we have in our stock analysis platform, which is similar to Bloomberg for the equity analysis part, we have a premium plan, which is worth 2,000 rupees per person. And we can offer that to all NISM students till the time they are they're studying from home. So that, they get a premium tool to also implement what they are practicing. So I'll be happy to offer it free of cost to all NISM students, and we can get it activated.
Yeah, this will help a lot to all students. Thank you for offering.
Right.
Yeah.
Right. Done. I'm done. I'll be open for questions. I just wanted to keep it very light.
Yeah. Thank you very much, Pranjal.
Thank you.
It was a very interactive session, and in fact, without any presentation in front of you or without any content, the way it was like as if you are sharing your experiences and your words of wisdom, and being part of an audience to get all of it in only a 45 minutes time frame. I enjoyed it very much. I was like that it should continue more and more and more. So I never realized that we have spent 45 minutes and more in this conversation. In fact, I also follow you on YouTube, and whenever I see you on YouTube, I feel very proud that one of us has made that presence in masses. He's helping us, or helping all of us in spreading that financial literacy, financial education to the bottom level of pyramid in a place like Raipur, and dealing with people who have very little to save and who don't understand anything about stocks, explaining them that let's keep it simple, let's buy good businesses, don't go for complex businesses, have your own circle of competence. We need not be brave. All you need is patience. It's good to be boring. Boring is the new bold, if I can phrase that way. If you want to make money in stock market.
I'll use that. That's nice.
Yes. So, in fact, for students also, I would recommend each one of you to follow Pranjal on YouTube. I personally enjoy it a lot. Every week, I see one or two alerts in my YouTube account that Pranjal has uploaded a new video, and I enjoy going through that video. Many of them are in very plain and simple language. Like even if you are not a stock market person, you also upload a lot of videos in Hindi and very
Right.
simple usage of words. But at the same time, the message goes across very beautifully and in a very crisp manner to all the people, and this is something
Thank you, sir.
I appreciate personally, and all of us appreciate it.
Thank you, sir. Thank you so much.
Yeah.
Thank you. Honor.
Moving
Any
on
question?
to questions. So
Right.
there are some questions around, like when you analyze companies, and people look at quantitative factors, people look at qualitative factors, people have their own models, and in between you have said that in some cases it's better to buy blind without building any complex models, without doing any complex
So,
valuations. So
so
in terms of your experience, which kind of information you look at more, whether the quantitative information or the qualitative information, and how do you approach the
right.
analysis before buying a company?
Right. So it has to be qualitative because quantitative will not make any sense until I know the quality of the product. If I tell you that do you want to buy a shirt that's worth 1,000 rupees, you just cannot make any decision out of it until you see the quality of the shirt. And then comes all fashion factors, but quality is critical. So any value, we can put a price tag to any value only once we know the quality of the product. So there has to be no compromise on qualitative analysis. And yes, I mean, it's slightly tougher to do qualitative analysis because there's no fixed way. It's not taught. It's sort of a field that's ignored. So I'll just tell you a couple of things what we do for qualitative analysis. Uh, before actually jumping into qualitative analysis comes the due diligence part. So what do you do on the due diligence part so that you know that because the due diligence is fine, what quality you perceive is actually the right quality, and company is not trying to make you believe that the quality is good when it's not. So first comes due diligence, and due diligence would be checking if the company has been in certain conflicts or is being penalized by SEBI, by government, by income tax department, whether the promoters, their integrity is intact. Next comes how much, if it's a company which is managed by owner promoters and does not have a professional management, then I would very closely look at the salary structure of those managerial person, because it shouldn't be a case wherein the promoters are shareholders but they also act as the managers and then take huge salaries out of the company, because then it's not a level playing field. Then they are putting themselves on a higher pedestal. Ideally, owners should be same as minority shareholders, and they should earn when the minority shareholders earn. So if owner promoters are taking substantial salaries, and the trend also, say the company had a bad year but the salary of the management increased, it's a very, very bad sign. It shows that they don't care about shareholders at all. So even if it's increasing, it should increase in tandem with the profits of the company. That's one. Second is related party transactions. This is again a giver, wherein you launch a listed company, you take money from public, and then through related party transactions, you divert that money to your sister concerns, to your cousins, to your relatives, and things like that. So the more number of related party transactions, again, this is very general. There are certain companies in which, because of the business structure, there has to be a lot of related party transactions. But for most companies, if there are a lot of related party transactions, especially compared to its peers. So if you compare, say, a Hero Moto with a Bajaj Auto and a TVS Motors, if you just check out the related party transaction of these three groups, you'll in 5 minutes you'll figure out which is the company with the best corporate governance. So I was very happy that Prateek has worked with TVS Motors. You'll find out that TVS has the best ethics. I'm not saying others are bad, but TVS has probably the best corporate ethics in India. So ethics is again very important. One key giveaway usually is that in an annual report, the first 2-3 pages, which are the non-statutory pages, companies try to advertise and try to highlight certain of their achievements in the last few years. Now, you can tell a lot about the management of the company based on what they are highlighting. I see a lot of companies in the previous year they highlighted PAT, and this year they took on debt, their PAT has decreased, so this year they have highlighted EBITDA. So what is this? You can clearly see that they are trying to show something that they want to, but which does not give you the right picture. Because if it's a stable company, established profit earning company, it does not make any sense to highlight EBITDA instead of PAT, especially when you've been doing it in the previous year. If you highlight PAT every year, it's fine. But if you change it every year according to what looks good, it's window dressing. And again, you get a sense that, okay, I cannot trust this PAT. Apart from that, follow them on Twitter, follow them on LinkedIn. The kind of messages they write, the kind of things they share, watch their interviews on CNBC, on Business Magazine. Yeah, video is something which is very intuitive, and if we watch a person regularly, if we stalk a person, more or less, we can make a fair idea about the integrity of that person. It's just so visible on a video. So just watching how that person behaves in public tells you a lot, whether that's a humble guy, this is an arrogant guy, and you get a lot of it. So this due diligence is extremely important so that you don't get into the wrong company or into a value trap. And then comes qualitative analysis. So which is again I think I've already answered it in a very long way. But before qualitative analysis, let's make sure that you do the due diligence part more, because this is where you'll avoid absolute blunders. Even if then your quality analysis goes slightly wrong, if you do this right, you'll avoid absolute blunders.
Yeah. Thank you very much, Pranjal. Another thing which you mentioned during your talk is that you at Finology, you don't follow market on a daily basis. Which is unlike many other financial advisors. Even we are passive investors. I only hardly put money in SIPs, but I also tend to see CNBC on a daily basis. I am not an active investor. I only put money in SIPs, and that's still. And you being actively involved in advisory, actively involved in managing money, you said that your mantra is that don't follow market on a daily basis. How do you stick to that mantra, especially in volatile times, like the thing which happened in current March? Nifty went all the way from 11,000 plus to at the bottom of 7,800. Or even in past, when BJP came into government for the first time, we saw an upper circuit immediately on that day, and then market was going up for another few days. So when the markets are very volatile on either sides, they're rising up very fastly or they're falling very fastly. How do you stick to mantra at that point of time, and how do you manage the panic being caused by your investors? Or maybe you might be feeling panic among yourselves, whether I should stick to that investment or not, whether I should cut my losses or not, or whether I should book my profits or not. So how do you approach those kinds of situations?
So so of course, I mean, during very volatile times, this rule has certain exceptions. I've always believed that no rule is absolutely perfect. You've got to be flexible enough. Having said that, the guiding principle is that don't seek this noise, don't seek this information. Let the information come to you. For example, I'll never actively read Economic Times or watch CNBC to see what's happening. But if you find suddenly that on a given day, on the front page of Times of India or Dainik Bhaskar, you see that market has crashed by 2,000 points and things like that, then you are not seeking information. The information is coming to you. So when you find that, okay, information is coming to me, which means these are abnormal times, these are rare times, of course, then you go and seek remedial action. But then we have to realize that in the longer run, volatile days are probably 2%. In an year, we have probably 5, 7, 8, 10 such days. So it's important. It's not important what you do, whether you go and watch CNBC the entire day in these 10 years, it's perfectly fine. It's important that you don't do this in the other 300 trading days. So because these days, I agree, it's not when the market is doing well, we are sitting and relaxing. But yes, when the market crashes, we try and to do fishing then. That is something we really like, when the market has crashed substantially. So what we have done is we have certain filters at our backend, and if any index falls by these many percent, it sends us an alert, and that is when our team gets into action, which again is very not proactive in the sense that you are not opening the app and checking if the bank index has fallen by 3%. You have set up an alert. If it falls by 3%, you will get an alert. So you are saving a lot of time in trying to see if it's falling. So don't seek entertainment in finance. In volatile times, of course, you can be proactive.
Yeah, thank you, Pranjal. Another thing which is going to be important for many of our audience, you are among the smaller subset of candidates who end up setting up something for themselves. So you are an entrepreneur, whereas whether your batch or any batches before you or after you, a larger proportion of the batch starts their career with working for someone rather than working for himself or herself. So how do you probably decided that I don't want to work for someone else, I would rather work for myself? And in this very little time, you have set up a very big venture, very popular venture, and now you are granting employment opportunities to masses, including your fellow students at NISM. So this has worked out very well. But at that point of time, when you were about to graduate from NISM, what made you probably confidently take the decision? No, I want to work for myself and not for someone else. If anyone in the audience wants to probably consider this as an option, what are some key advice and key words of wisdom for you from you to them in terms of how they can prepare themselves and what kind of probably challenges or constraints they should be prepared for if they want to venture out for doing something on their own?
Right. So, it's a very personal journey for everyone. I'll tell you why I had this thought. So, when I was in class 5, just for fun, we started a comics renting business, me along with my friend. And in the 2 months, we realized that as 10 years old, this is for the first time when our pockets were full with money and we did not need to depend on our relatives and family and maybe touch the feet of the elder ones to get a note of 100 rupees. We were independent. So, as a 10-year-old, that sense of independence was just like nothing else. We just, because, as a 10-year-old, what expenses do you have? You just probably want a 1 rupee toffee, a 5 rupee dairy milk and things like that. And to suddenly have thousands of rupees and not knowing what to do with it as a 10-year-old was a brilliant feeling. So somewhere within my heart, it was decided that, okay, this is what I'll do. I'll do something of my own, because one key thing, and I mean, when I matured during NISM, there were again 2 factors. One was my roommate was someone who had a lot of experience working in the financial industry. He was my roommate at NISM. He had 6 years of experience on the sales side of working in the financial and banking industry. So every night before we slept, we had this huge couple of hour philosophical and practical discussions wherein he would mentor me. So every night he would tell me one or the other horror story of how the so-called most reputed financial brand in India missold to clients, how it was basically absolutely a scam in terms of banking, broking, insurance, how people are missold the wrong products and things like that. And so, he did not tell me once, twice, or thrice. He told me one or the other story every day. So it was ingrained in my mind that, okay, I don't want to do this, because I knew that I'm not someone who knows a lot about debt side, I don't know much anything about other aspects of finance except equity research. And so I tried at a couple of firms, to be honest. I believe Bhati sir was there and he was our placement in charge back then. So I told him, I was in fact part of the placement committee, and I was the one who was selected by the most number of votes, because everyone in the class knew that since I'm not sitting for placement, I'll not snatch their placements in my interest. But then I told Bhati sir that I'm not sitting, and he would ask me that what are the kind of placements you want. So I told them that these are the only 2 firms. There were a couple of firms, they still are, and I still respect them. If these 2 firms offer me a job, I'll be willing to go. Otherwise, I don't want to go. And he tried his best to convince people at those organizations to take me, but they did not even consider me for an interview because there was no vacancies back then. So then I decided that I'll do something of my own, because I don't want to be part of the mainstream industries. If these 2 companies take me, it's okay. Otherwise, no. And the second reason was that, say you get a job worth 12 lakh rupees a year. You get the max, the most, a great package, 12 lakh rupees a year. And you are the best possible employee that the company has had in recent years. In the next year, what growth can a candidate expect? Even if you are exceptional, probably you grow from 12 lakhs to 18 lakhs, 50% growth in a year, not more than that. And then your growth from then onwards cannot be exceptional, even if you are the best. Whereas entrepreneurship is something wherein you're earning 1 lakh a month in the first month, second month your product goes viral and you're earning 10 lakhs, third month you're earning 50 lakhs. So it's not about money, because I have strongly believed that the marginal utility of money drops very quickly once you reach the 1 lakh per month level. When you graduate from 10,000 to 1 lakh, it changes your life. But from 1 lakh to 10 lakh, it does not change your life that much. But so not in only in monetary sense, but in all senses, entrepreneurship gives you an opportunity to get your exposure 10x in 3 months, get your understanding of everything. So as an entrepreneur, I know a bit about web development. I know a bit about digital marketing. I know a bit about compliances. I'm a bit of a CA. I'm a bit of a CAS. I'm a bit of a lawyer. I know analysis. I know content writing because of the people around me, because of the projects that we discuss every day. Sometimes I'm involved with this team, sometimes the other team. So your growth as a person, apart from money, someone might be prime focus might be money. The growth could be exponential if you're successful. But even your growth in terms of non-monetary things, growth could be absolutely exponential. So this non-monetary growth really drives me. I mean, the network you get, the visibility, and a lot of other things. So the kind of person I am also reflects in the kind of products we build. Probably this is the reason that we build B2C products, which are visible, which are accessible to the masses, and which helps them avoid those scams and frauds that are very prevalent. So this is why I also believe in just stalking the entrepreneur, and you will realize whether his products or what he promises he can deliver or not. So it's just the feeling of and the possibility of unlimited growth that drives me towards entrepreneurship. Having said that, it's not for everyone. I mean, it's very the startup India has got really a trend in the last 2-3 years. But you have to understand that although these days running a startup is very cool and is very respected, it's the new trend. Everyone wants to start their own startup, but it takes a lot out of you. I mean, I have not taken a holiday in last 3 years. It's absolutely impossible. Sundays are working, Saturdays are working. We are a startup, learning new things every day. There's no personal life, no social life. It's all customers, consumers, and how can we make it better? How can we offer a new thing? Things like that. So it takes a lot out of you. Every day there's a new crisis. Something or the other happens. You got to, and imagine this feeling. So when I started, I was a 24-year-old when I started this business. All your life, if you do something wrong as a student, I just came out of NISM and I was on my own. So in my school, in my college, at NISM, if I do something wrong, I either have my parents to correct it, either have my teachers to correct it, friends to correct it, and help me get through it. There's always someone who can assist me in something. But when you launch your startup, now instead of you seeking help, you find that 30 people under you, no matter what they do, they look up to you for help if something goes wrong. And you don't have anyone to look up to. So no matter what the crisis is, you have to solve it or you perish. And not just once, twice, day in, day out, for my entire life now onwards. So it takes a lot out of you. So it's not for everyone. But yeah, I mean, I'll take it any day for the thrills it offers.
Yeah, it feels very energizing listening to your experience. In fact, we feel that life is much better on the other side of the table if we were entrepreneurs ourselves and working for ourselves. Another thing, you have also mentioned that students should devote good amount of time, in fact, a lot of time outside their curriculum to do self-learning at their level or do reading at their level. And in fact, you are popular among your batch. In fact, you are popular in NISM per se for utilizing the library at its full optimum potential. You would have read so many books in library. You follow Warren Buffett. In fact, the thoughts which you were sharing in the last 40-45 minutes, many of it resemble to the thoughts of Warren Buffett. You have written a book yourself, and when we see that available in every bookstore, in Amazon, in Flipkart. So, any tips from your side to students in terms of what all they should be reading, what are the resources available, or if you can name some good books which they should be reading if they want to understand financial markets better. Any of your experience you would like to share with regard to reading beyond the curriculum?
Sure. I remember what I did at NISM on my first day at NISM. I had not even seen the campus, not hostel, directly landed on the Vashi campus and straight went to the library. And I took a small diary I had and I checked prices of all the books available on value investing and equity valuation and prepared a descending order, the highest price one on the top and then on, because I knew once NISM was over, I'll not be able to afford those books. So I started with the highest priced ones. But now that I have gone through all the books, you don't need to do that, because some highly priced ones were not that good and some really affordable ones were very good. So I'll give, so the best book I have read has to be The Education of a Value Investor by Guy Spier. Absolutely the best book on investing. Apart from that, all the 3 books by Peter Lynch are very good. All 3 books are available. And one expensive one and one I really liked is Poor Charlie's Almanac. I wouldn't recommend you to start with it. It's slightly complex. It talks about psychology and behavioral patterns. So do not start with it. But I mean, if you read that and if you understand all of it, you can be very sure that you are set to become a successful investor. Apart from that, there's a book on, I'm just forgetting the name just a second. There's a book on the art, there's a book on mental models. I'm just forgetting it. I'll just text you, but a book on mental models is there on NISM, just forgetting the author. Again, one of the best book on how it talks about from which mindset should you analyze an IT stock, from which mindset should you analyze an FMCG stock. So it has a blue cover. I'll just text it to Panda sir, but a very good book. But the first book that you should be reading is The Education of a Value Investor by Guy Spier. And books by James Montier are very good. But yeah, I mean, Peter Lynch, Guy Spier, these 2 authors, and Poor Charlie's Almanac. If you complete 3 books by Peter Lynch, 1 by Guy Spier, 1 by Poor Charlie's Almanac, these 5 books, and you'll, because once you are done with these 5 books, what next to read, these 5 books guide you. They show you the path on where to proceed from now on. So do read these 5 books. It'll take a good 2 months out of your life, but totally worth it. And I'm really sorry for the students. They don't have access to campus and they don't have access to library. So yeah, I mean, that's really unfortunate.
Yeah, it's a temporary phase. All of us are struggling with it, but I guess they are with NISM for 2 years, and it's only a couple of months.
Yeah,
we hope to see them at our campus in maybe a couple of months from now. Yeah. Thank you very much, Pranjal. Before we close it, any final words of wisdom from your side for students in terms of how they should be utilizing the next 2 years? In fact, how they should be continuing their learning and skill development journey throughout. What are your experiences?
Yeah, I mean, one very key thing here is not to study out of fear. I mean, I saw a lot of really bright minds during my batch, but during exams they would shiver out of fear. What if I don't clear it? What if I don't top the class? What if it doesn't go well? So it's important to learn while not being fearful, because when you are afraid and you learn for the sake of topping the class or for the sake of doing well in your exam, you're really missing the point. As soon as I was out of NISM, no one asked what I scored in this particular subject, how well did I do in that particular subject, and I'm an entrepreneur, that's okay. Even for all of them who landed good jobs, no one cares how well you did in a particular subject. So understanding the core concepts is key. I'll be very honest. If you tell me what is the formula for compound interest, I don't know it. I don't know, and that's because I don't need to know it. You need to understand that there are certain things machines are good at, there are certain things humans are good at. All you have to focus is understand the importance, consequence, and meaning of compound interest, so that you know that if this thing compounds at this percentage, considering the risk, whether it's good compounding or not. That is what you want to know, right? You need to understand how it works. You need to understand why it's called the eighth wonder. But unfortunately, when I ask people what is compound interest, they'll blub out the formula to me and smile with confidence. See, I know what is compound interest. But that's not compound interest. That's compound interest formula meant for a machine so that the machine can calculate it for you, right? So it's very unfortunate. I'm sure out of the 90 people present here, if I tell them after a couple of months that I want DCF of this company, all of them will be able to do it. But whether DCF was the right thing to do for this company or not, a lot of people will not understand. So understanding concepts is key. No matter what you study, I don't, if you study all that, I studied a selected subject. I believe I should have studied all. It broadens your horizons. I would always say that learn all the subjects diligently, at least the basics of it, so that when a problem arises, you can think from a student of econometrics, you can think from a perspective of a student of tax, from the perspective of a law student. So understand the basics of everything, but don't try and just blindly rush after excelling in exams. That's not the point. Even if you score half of what is required, what the maximum marks are, but you understand the core concepts, that's much, much more important.
Thank you very much, Pranjal. So
Thanks,
I think we took a lot of time of yours, but whatever we discussed, we were enjoying it, and we never realized that we are more than 1 hour plus in this conversation. It's always pleasure to listen to you, and we look forward to further listen to you many more times. In fact, all of our students look forward to meet you in person whenever we resume our activities at campus. We would look forward to meet you in person and interact with you again, continue the conversations. For this moment, on behalf of the students, all the faculty team and NISM, I and Dr. Panda sir would like to take this opportunity to express our gratitude to you for sparing time on Saturday morning and for sharing these words of wisdom, for sharing your experiences with the students. It means a lot for all of us. It will broaden our horizons. It will broaden our perspectives in terms of how we should be utilizing the coming years and how we should be developing us personally as well as professionally to prepare ourselves for a better career in markets. As a token of gratitude from our side, that's some words of appreciation for you.
Thank you.
I would request Panda sir if he has any words to add to coming at this point.
Thank you, Ritesh sir. Thank you, Pranjal, for a wonderful presentation, and I think students will get more benefited from you and from your YouTube channel, as well as you are really great help to them because they don't have access to our all paid databases here. And there are a couple of things that they can start from today onwards. They can get it from you, how they can start from today onwards, and they can also get the points from Pratik. So there are two ways for them now. Either they can start at their own, they can work for themselves, or they can work for others. It depends on their appetite, their risk appetite, their objective. But decide from day one and start working from that. That's what you told all of your experience from day one. You have started utilizing library, rushing to library, not to see the campus or not to see the hostel. So students will get more benefited, and some of the concepts maybe it is going on over the head of the students, because many of them are freshers and they are new to some of the concepts like commodity or in the investing. That's why students, you need not worry. That's why you are here to spend 2 years of time. If you could have known all those things, you could not have joined the course. So you need not worry for the concepts that are there in the presentation of Pratik or Pranjal. So you start working on, you have all the they have given you a bunch of things, and after 2 years you are becoming our alumni. We will call you as a speaker, so you decide how you will come. You will come as an entrepreneur or you will come as an employee of an organization. We will welcome all of you. So I would like to thank Ritesh sir for moderating, and I would also like to thank our IT team. Vikram is helping us a lot. And I'd like to thank our Sahil sir, Lata ma'am, Resma, Asutosh, those who are working, and our own students also. You Alumni Association. So we'll be sending to Pratik and Pranjal. We'll be sending the certificates via email. And once we resume to campus, we'll send the physical copy. And with this, I'll take a off and we can close the session. Thank you.
Just one point.
Yeah.
Sir, regarding activating that ticker plus, what we'll need is we'll need an Excel sheet of all the students along with their email, so that we can activate that at our backend and send activation to everyone, so that they can start.
Okay. We will share it with you. We will share it with you, Pranjal. And thank you once again for this access for our students. It will definitely help all of us to
always.
Yes.
You can also share with faculty members as well, Pranjal. They can
sure,
also
so on the Excel sheet you can include their name as well. I mean,
we'll include and send you. Yeah.
Right, sir.
Okay.
Yeah.
Thank you.
Thank you, sir.
Thank you very much, Pranjal, and thank you, Pratik. It was pleasure interacting with you, and we look forward to having more opportunities to interact with you, probably next time in person rather than on this virtual mode. Thank you very much for your time. Yes. Bye.